Okay, so here is the FM paper of Jan 2025. Part 1, Section A. It was a case study based question, basically MCQ question from capital structure topic. Coral Limited is an agribusiness company that operates in two segments, animal feed and crop protection. The company's R&D has been instrumental in its growth and success. Existing capital structure, equity and debentures, both. Coral Limited desires to expand its horizon in breeding high-yielding and disease-resistant seeds for increasing agriculture productivity. Company requires additional fund of 100 lakh to finance its business plan. You already have 100 lakh equity plus 30 lakh. That means existing 130 lakhs and you're planning to add another 100. The expected EBIT after this investment will be 76 lakh expected. The applicable tax rate is given. Company has two alternative plans of raising this additional fund. That means this below is applicable only for the additional 100 lakh. Plan 1 will go for 30% equity and 70% from debenture. Plan 2, some equity, some debenture and some preference share. Now the question, they want you to solve question 1 to 5 and each MCQ you can see here is for 2 marks. So it was earlier used to be a 10 marks question, now converted into 5 questions of 2 marks each. What would be the financial break-even point in plan 1 and plan 2? Now financial break-even point is achieved when you're able to earn enough money to pay interest, taxes and preference dividend. Indirectly, earning available to equity shareholder should be 0. You can do it in 2 ways. Either let EBIT be X minus interest minus tax minus preference dividend should be 0. Or you can do table reverse order, fill earning available to equity shareholder as 0. Then preference dividend, then PAT, then tax, add back tax, then interest, and then you can get the number. Both they have asked. Second, what would be the indifference point? If you remember, indifference point is a level at which EPS in first option is equal to EPS in another option. So you have to start something like this. EPS, in plan 1 should be equal to EPS in plan 2. Let EBIT be X minus interest. I think first and second both schemes have some interest to be paid and I think tax rate was given 30%. So let it be X minus whatever is the interest that you get, 100 lakh into amount of debt into rate of interest. From that, if you take out tax divided by number of equity shares in option 1. I hope you remember we have done questions with 3 proposals. Here they have asked only 2 plans. And this side, this will be X, interest will change. There will be tax, but if you see second plan, there is some preference shares also. So 40% of 100 lakh, that will be 40 lakh. On that, 7.15% preference dividend. That divided by number of equity shares. And then if you keep it as X and solve the equation, at the end the value of X is the answer that they want. Third, what would be the EPS in plan 1 and plan 2 at the indifference point as calculated above? Look at this question. When they say EPS in plan 1 and plan 2 at indifference point, what is the meaning of indifference point? The point where EPS should be same. Correct? And if you see the options, 1.3, 1.3, this can't even be the answer. When you call it indifference point, EPS should be same. If you remember in one of the class questions, we calculated EPS and then I added one class work. I said in class we will work out the EPS also. If you have capital structure chapter with you, everyone, last part of capital structure, page number 125, I think. Not 125. Yeah. This sum. 127. Question number 9 in class material. It says find out indifference point, plan A and plan B. In class work, we have done check whether the indifference point is correct or not. How will you get to know whether indifference point is correct or not? EPS should be same. And if EPS should be same, definitely option B and option D cannot be the answer. It has to be either 1.3 or 1.5. If you have the class notes also with you, you check. I think we got 1.4 rupee EPS in both the combinations. Number of equity shares were different, but then you have done it in class. You started with plan 1, plan 2, EBIT minus interest, this, and finally you had 60,000 rupee by 40,000, correct? In one option, you got 1.4 rupee, 1.4 rupee. If you call it indifference point, your EPS answer has to be same. Next one, what would be the earning per share of the company in plan 1 and plan 2? How to do earning per share? To reach earning per share, you need earning available to equity shareholder. For earning available to equity shareholder, correct, denominator is okay, number of equity shares. How to get earning available to equity shareholder? In the question, EBIT was given. I read it, I think 90 lakh was the number. From that you have to pay interest and then tax. If there is any preference dividend, take that out. Divided by number of equity shares. How to get number of equity shares? Total fund that you want is 100 lakh. Equity share of 10 each they have already mentioned. So you'll get to know how many shares. Correct? And here issued at a premium of 15 per share. That means one share when you issue, you'll get 25 rupee. One share when you get, you won't get 10 rupee, you'll get 25 rupee. That means 100 lakh into 30%, that much of amount should come from them. That you divide by 25 rupee, that will tell you how many shares. Correct? And then if you divide earning available to equity shareholder by number of equity shares, you will get to know how much is the EPS. This answer need not be same because this is not indifference point answer. This is the general EPS question. Last one, what should be the market price of the share if PE ratio is 12 times and PE ratio in plan 2 is 15 times. This PE ratio is part of ratio analysis topic. And what do you do in PE ratio? What is the formula for PE ratio? MPS by EPS. And if they're saying this should be 12 and they're asking you how much should be MPS, you have calculated EPS in this answer. Correct? Suppose 4.37, I'm saying just suppose. Then 4.37 into P ratio should be market price per share. That means if fourth is correct, fifth will be correct. Fourth is wrong, fifth will also be wrong. Correct? P ratio is MPS by EPS. P ratio they have given. EPS you have calculated. Just a multiplication will give you the final answer. Done? Next, case scenario 2. Here this was a ratio analysis question. They have given these details to you. Current ratio 1.5:1. That means current asset by current liability 1.5 by 1. Sales 150 lakh, in that 80% is credit, balance is cash. Inventory turnover ratio, collection period, GP ratio, quick ratio. All the things are very, very easy. Not even one confusing item. And what they want, answer question number 6 and 7. That's it. 2 marks, 2 marks, 4 marks question. Inventory and receivable amount, current asset and current liability. That means in this 2 mark, understand 1 mark is for inventory, 1 mark is for receivable. But then you have to have, and look at the options they have made. 20, 20, 10, 10, 10, 20. No other combination is possible also. Okay. Inventory and receivable. Tell me, inventory, how will you do? You have inventory turnover ratio, GP ratio, sales with you. With this you can find out COGS. Now if you have COGS, if you have left hand side turnover ratio, denominator is your inventory. First. Second, 80% is credit sale. That means 150 into 80% will tell you amount of credit sale. And collection period is 2 months. What is the meaning of 2 months? In a year, 6 times. From this you can do DTR. Correct? DTR is equal to credit sale divided by average or closing debtors. Left hand side is ready. Numerator is ready. Correct? And then you have quick ratio. Tell me how to use quick ratio. Current asset minus stock. Just now you calculated stock and you know current ratio 1.5 and 1. Now if I write quick ratio formula, current asset minus stock by current liability. They said quick ratio is 1:1. That means this is 1 is equal to, we don't know CA and CL number, but we know ratio is 1.5:1. That means if I keep this as X, this will be 1.5 minus stock that we calculated just now. With that, you will get to know how much is X value. X value will be CL value. 1.5 of that will be current asset value. And that is your next question. How much is CA and how much is CL? Easy 4 marks actually. And that too, ratio analysis, there are so many complex formulas they can ask. They have asked the very basic simple GP, debtor and inventory. Next, question number 8. JKL Limited has current assets of 1 crore, current liability of 50 lakh. Financial manager of the company desires to make a provision for contingency 20% of working capital. Accordingly, what would be the amount of working capital? If you do CA minus CL, you will get to know the amount. That is without considering the safety margin. And on top of that, if you take additional safety margin, if you remember, we did one question. We calculated total CA, total CL, CA minus CL, we got working capital. In that question, they said you have to add 20% safety margin. Remember, here they are talking about 20% margin. And this question, 1 itself is more than enough according to me. Okay. This is section B. From here, the MCQ part is from strategic management. So FM was only these many questions, because you cannot ask more than 15 marks, and you saw already 7 questions, 7 into 2 plus this one MCQ, 14 plus 1. Okay. I'm now moving on to the descriptive part of FM paper. Yes, here is the descriptive part. Question number 1A is cash budget preparation question. This is from working capital management. I think this is the latest chapter that we have done. Estimated monthly sales, April to September, all numbers in lakhs given. GP ratio. Now, if you have sales and GP ratio, you can find out COGS also. COGS is paid in the next month. That means April month cost is paid in May cost is paid in June, and so on. Sales are in credit, and credit period allowed is 2 months. So you sell something in April, you won't collect in May, you will collect in June. So any month cash receipt is equal to that month minus 2 months. You have to go back 2 months and collect. Indirect expenses are paid in the same month. After that, monthly indirect expense list given, same month you will have to pay. Dividend of 3 lakh will be paid in the month of September. When you pay, it's a cash outflow. Cash balance on 1st July, maybe this is the opening balance. And if you see last line, you're required to prepare cash budget for 3 months starting from July. That's why the July number is the starting point, opening balance. Then they gave this condition. Company has to maintain minimum cash balance of 1 lakh. If there is cash balance deficit, company will take short-term loan. And if cash balance is more than 2 lakh, then they will invest. If you remember, there was one homework question like this. Neither you should be below that, nor you should be above. If you have shortage, you take loan. If you have excess beyond upper limit, then you make the investment. Ignore the interest on the short-term loan and the money that you make on short-term investment. Some months you have shortage, you take loan, and next month you may repay, but the interest you do not have to worry. That's all question. This is probably the easiest cash budget question anyone can create. Okay, we have done much better questions surely than this. If you have book with you, come to working capital management. In the treasury management, I think the first question itself was much more detailed than this. Or you can even come to this page 170. You have a similar question. Estimated sales, wages and salaries. Here you have more complication. Some part is credit, some cash, 75. They haven't kept all this. They made question much easier. And here you had this minimum balance. Any cash surplus or deficit will be invested, or we will liquidate, or if you still need some money, we can take loan. And they said interest on these can be ignored. This question and even first question of the topic that we did in class, even that had more adjustments actually. Our first question itself had, I think, cash and credit both. In exam question you saw there was only credit sale. Yes, this question number 1. If you remember in class, this expense they did not give you, and we made an assumption that it is paid in the same month. And in exam, that also they clarified, no confusion to you. Indirect expenses are paid in the same month, right? Much easier question actually. Yes, back to question paper. Question number B. Here you notice 2 plus 1 plus 1 plus 1, 5 marks, and here they have asked you to calculate 4 things. Now you know how they are going to allot marks. They gave you balance sheet, equity, reserve, debenture, current liability, FA and CA. After that, the additional information is as under: fixed cost per annum 16 lakh, variable cost 70%. You know what is total asset turnover ratio. With this you can find out your sales value, income tax rate given. You are required to calculate EPS, DOL, DFL and DCL. At least 1 or 2 questions in class, 2-3 questions in part B on this variety. I even remember this. There were 2 similar questions in part B. I said don't do both. One you do and one you don't even have to do. This was from risk and leverage topic. If you can come to risk leverage, anyone, if you have got that question already, tell me the page number quickly. Yes. This page number 57, exact same question. Share capital, I am keeping both open in front of. Share capital, retained earnings, debenture, current liability, FA and CA. And then look at the 4 adjustments also: fixed cost, variable ratio, asset turnover, income tax. Fixed cost, variable operating, asset turnover, income tax. You are required to calculate 4 things: EPS, DOL, DFL and DCL. Calculate the same 4 things we have done in class, and similar questions I'd asked you to practice at home also. On screen you can see there were questions in part B. See this itself, page number 63. Now balance sheet, just the T format is not used, otherwise it is same way: equity, reserve, debenture and current liability, non-current and current. See this: variable cost, fixed cost, asset turnover, income tax. And prepare income statement to find out DOL, DFL and DCL. Had come already once in question paper, we did once, and then almost same or similar question has been asked. Next, question number C. This was for 5 marks. They have given PBT, tax rate, equity, return on investment, cost of equity, dividend payout ratio. Tell me, if payout ratio is 50%, then retention ratio is 50%. You are required to find out price of the share as per Walter model. Determine payout ratio by adopting Walter model, assuming the price should be 48. Come to dividend decision. I think in class material it was 3rd question where you had this same question. Yes, on screen, page number 145. Question number 3, you can see here, profit before tax, tax rate. Here directly net profit was given after tax, otherwise it is same thing. Equity, share capital. Here at least we had preference shares, we have paid dividend, and then number of equity share, R is there, cost of equity, KE is there, same thing, R is there and KE is there. Dividend payout ratio they have given, and here look at this: compute the approximate dividend payout ratio so as to keep the share price of 42, and in exam determine the dividend payout ratio so as to keep the share at 48 rupee. And if they have given payout ratio already, then this is like these questions: find out what will be the price based on the payout ratio. And this chapter in part B, there were so many similar questions to practice. Walter and Gordon were the most repeated part B questions. See this: number of equity, return on investment, cost of capital, net profit, outstanding preference shares. If you have practiced these sums, this question paper was actually doable. Next, this is one question they asked for 7 marks, and if you look at the marks distribution, 1, 2, 1 and 3, that means there are 4 sub questions. So even if you don't get the final answer perfectly, if you do the working notes and steps, if the approach is correct, assume your final answer is wrong, you can still get 4 out of 7 if your first 3 sub questions are correct. So do not worry much about final answer being 100% correct. Is your approach, working notes, formulas, if those things are appropriate, you will get the marks. Following details are related to CMC Limited: number of equity shares, convertible debentures, bank loan, market price of equity, market price of debenture, face value of equity, face value of debenture. Beta is given. Risk-free rate is RF. Risk premium is that RM minus RF, rate of tax given. Company expects that the share price will rise in future at an average rate of 6% per annum. If you remember, for convertible debenture, whether the debenture holder is going to take shares or he is going to take cash depends on that day's price. Able to follow what I am discussing? We have done this question. Convertible debenture, how will the debenture holder decide? He will compare how much is share price, expected share price versus cash value. Whichever is higher, he will pick up that. Here they are saying company share price will grow at 6% per annum. That means whatever is the market price now, where is the market price? 55, and this will grow at 6%. The 10% convertible debenture of 100 will be converted in 6 years time into equity shares in the ratio 1:4, 4 shares for each debenture. But remember, as of now it is worth 55. It will grow at 6% for how many years? 6 years, correct? That means 55 rupee into growing at 6% for 6 years. Or if you remember in Calci, if you do 6% plus 6 times, you will get to know how much will be the price. That day, he will compare whether this is better or taking cash is better. Market value of 12% bank term loan is at par. When they say market value is at par, that means market value or book value. Either way, you take the same number. And if you remember, for bank loan, market value is always equal to book value. I told you this, you can't buy and sell loans, but you can transfer from one bank to another bank. So the market value is always book value. First question is cost of equity using capital asset pricing model. If you remember, this is RF plus beta into RM minus RF. And I already read in the question there was beta, there was RF, and there was premium amount given already. Second, cost of convertible debenture using approximation method. Approximation method is that formula KD is equal to I into 1 minus T plus RV minus NR by N whole divided by RV plus NR by 2. If you remember, there was one more method called YTM, which uses the IRR technique. And if both were asked, answer need not even match. YTM gives a different answer compared to approximation. Here they have clearly mentioned you have to do under approximation only. And then they want you to do cost of bank loan, cost of debt. One is debenture, even bank loan is debt itself. Simple formula. Anyway, bank loan will not be redeemed. Therefore, it is simply I into 1 minus T divided by net receipt. Then they want you to do WACC using market value. List out the sources and its market value, not book value. And then assign the weights. And then you have to bring KE, KD. And here there are 2 debts. One debenture and one more was loan. So your answer will have equity, convertible debenture, bank loan. Amounts, weights, and then cost into weight. Next, question B. This was from working capital management. 1 plus 1 plus 1 plus 3. By the way, this previous question we have done it in different places. CAPM only in cost of equity you have done. KD in approximation method you have done. This at the end of the chapter we did WACC. both book value and market value. This question is from cost of capital. Yeah, this question is from working capital. This is probably the bonus for all those who wrote attempt this time. Following information is given for the year ending 31st March. RM period, WIP, FG, collection and creditor. If you just add all this and deduct the creditor period, you'll get to know one cycle period. And that itself they've asked us one question. Annual operating cost, including depreciation, is 60 lakh. That means you have to minus that 4,80,000. And clearly, at least one thing you don't have to worry now. In exam, they will print 360 days. You are required to find out one cycle period, number of cycles in a year, amount of working capital required. In Calci, can you quickly finish this 61, 20, 30, 45? How many days? 96 days. If you take 360 days, 3 point exact, and then annual cost 60 lakh minus 4,80,000, 1472,000. Is that the final answer? Can you double check? 60 lakh minus 4,80,000 divided by number of cycles. Done. 3 numbers. They asked for 3 marks. Question 3A. This was for 6 marks, and this is from capital budgeting, NPV and PI. And also you need to advise whether it's a good machine or not. SRT Limited manufactures steel rods and is now considering purchase of a new aluminum smelting and molding plant. This plant will have a cost of 20 lakh to purchase and install. This becomes your year 0 capital investment. It has a life of 5 years, scrap value 1 lakh. The scrap value will take as inflow in last year, and using these 3 you can find out depreciation under SLM. Production and sales is expected to be 1 lakh units per annum, selling price and direct cost. So when you do your PBDT and then CFAT statement, you start with number of units into price minus number of units into cost. Fixed cost including depreciation is 8 lakh. When it is including depreciation, if you take it, the answer that you get won't be PBDT, it will be directly PBT, but you will still have to calculate depreciation because you need to add it back later. Marketing and promotion not included in the above is extra in year 1 and year 2 you have to take. Additionally, investment in debtor and stock will go up in year 1 and 2. Creditors will also go up in year 1 and 2. If you remember, this was that working capital. Year 0 normally you invest and last year of the project you get back. But here it is happening in year 1 and year 2. Anytime stock is going up, it's a cash outflow. Current asset is going up, that means you have to invest money. But if current liability is going up, that means you are kind of receiving money. Not receiving money, but you are getting time to pay. Correct? Then, and all of this money will come back to you in 5th year. I think you remember there was one slightly complex sum. Year 0 we invested, year 1 we invested, we kept same money in year 2 and year 3, and last year entire working capital came back to us. Do you remember? I think 17th question in capital budgeting. We have done this. Yes, this question, page number 14. Page number 14. In this, you can see initial stock of material required is 60 lakh. When they say initial stock, it is year 0. Stock level to be maintained at the end of year 1 to 3 will be 165 lakh. You had to make some extra investment for the stock to go up. And then they said stock at the end of year 4 will be nil because all the working capital, the stock will go out and cash will come to you. And here what did they say? Look at this. Thus all these current assets will come back to you at the end of year 5. So initially you invest, cash outflow, year 5 you get it back. Cost of capital is 18%. This is for your discounting rate. Tax rate is given and is paid in the year in which profits are made. Depreciation is allowed under tax law and company follows straight line method of depreciation. Standard NPV question. And see, one possible, one thing about which you keep worrying, present value factors at 18%, they have given. So you will not have to worry about this rounding of differences, that 360 days, 65, should I take weekly, monthly, daily? You have, now everyone should take these three numbers only. You can't take some other number, so there will be no problem of rounding of difference also. Question B was from ratio. Equity share capital of the company is given. Relevant ratios are given. Current debt to total debt to owner's equity, fixed asset to owner's equity, asset turnover, inventory turnover. You are required to prepare balance sheet of the company. Come to ratio analysis. I think this was there in a practice sum. Yes. Page number 265. Sorry, I'm just 265, is it? Is it similar? No, I remember one question was, yes, 268. Yeah. Net working capital, bank OD, fixed asset to owners, proprietary fund, reserves and surplus, current ratio, liquid ratio. You are required to prepare a summarized balance sheet. Yeah, next question actually, 269, same page, 28th one. I think this question is more or less same. Equity share capital 2 lakh. Look at this. Current debt to total debt to owner's equity. Fixed asset to owner's equity, current debt. Is it almost same numbers? Yeah, just the decimals are different. And basically they want you to prepare balance sheet. In this question, format was given, but format was also same 2 lakh rupee which is there. That wasn't of any use. Anyway, you had to do full sum as it is. And question is asked for 4 marks. Easy one. Not much of it. If you see first number you have is share capital. Tell me from there you can find out total debt. Out of total debt, if you take out current debt, balance is long-term debt. And once you get owner's equity, from there you can go that side with fixed asset. And once you get fixed asset, from there you can find out, no, 1 second. Current debt to total debt. Yeah, if you have total debt and owner's equity, you would have reached total liability. That itself is total asset. In that, if you have got fixed asset, balance is current asset. Now from total asset, you can do turnover, you will get sales, and then inventory turnover ratio. If you don't have GP or COGS, then inventory turnover will be based on sales. From there, you can find out stock value. Correct? And then the question is prepare balance sheet for 4 marks. Last question was all theory. Explain environment, social and governance linked bonds. This is there in chapter 8, types of financing. Discuss the objective and advantage of wealth maximization. This was in first chapter, profit maximization versus wealth maximization. Any two advantages of virtual banking in working capital management. 3-4 days back we have done this. Remember, you had very less energy that day and I discussed this. Same thing came in exam. State the concept of exclusion of financing cost principle. This is there in the chapter 8 when you do bank funding. In that long-term loans and short-term loans, in that you have the discussion of financing cost. By the way, if you look at this, 4 plus 4 plus 1 of this, that means about 10 marks is theory. Out of 50, 10 marks is theory. 15 MCQ marks, I'm saying all 15 were practical sums, correct? That means out of total 50, 10 marks is pure theory. And by the way, fourth question is for 10 marks. And this question, third one was also 10. Second one was also 10. First one was also 10, is it? Yeah, correct. And then there was this question. Before that, 15 marks was all MCQ, and then balance you only have to attend 50 out of 60 marks. But that doesn't mean, sir, anyway last one is theory 10 marks, I won't study theory and go. I really don't recommend this. I've told you this in the last batch also. Theory may be easier, theory may help you to save time, so do not ignore theory. Overall, according to me, if you have attended the class regularly and have done all the practice questions, FM paper was very, very easy. Okay. Yes, with this, we are done with the question paper discussion.